Today's webinar will be eligible for 1.25 CLE credits. A code will be announced at the end of the webinar for those attending, and a certificate will be sent via email to participants. Today, more regulatory challenges and opportunities for consumer financial services providers and their vendors, bank-fintech partnerships, and others are thriving and allowing many to provide increased services to consumers. But while it looked like there would be more federal opportunities to become chartered, there's signs some may be having second thoughts. What happens next? And in the payments world, there's no shortages of consolidation and changes that are offering different opportunities, but also changing the dynamic landscape. Plus, there's ongoing uncertainty about lending and collections by some when there's different state interest caps, and on the state level, for some level lenders, different licensing requirements. And after a lot of buzz about a more deliberate and reserved enforcement posture, the CFPB remains active, bringing enforcement lawsuits and launching investigations while also doing a backflip and launching investigations while also doing very active litigation. And in the real world, there's likely to be efforts to make permanent a rollback of the small dollar loan rule, issue a final rule on debt collection, and there's signals from the Bureau that it's looking to promote innovation while updating consumer financial law. And meanwhile, the states are moving to create mini CFPBs. So with all of that, there's no shortage of issues and topics to discuss, and the new year has just started. And welcome to Consumer Financial Services Outlook 2020. We're getting underway today on Wednesday, January 15th, 2020. So here we are in the new year, and welcome everyone to those that have joined us before. We thank you for rejoining us, and for those that are new to this, we thank you for sampling and joining us today. My name is Jonathan Pompan, and I'm co-chair of the Consumer Financial Services Practice Group here at Venable. And today we're going to be discussing a number of topics, including bank-fintech partnerships, the future of the CFPB, enforcement and litigation trends, payments, the regulatory agenda for consumer financial services, innovation and sandboxes, and of course, a view from Capitol Hill. And so I'd like to welcome our panelists, my colleagues and partners, Andy Arculin, formerly of the CFPB, Regulatory, Allyson Baker, also formerly of the CFPB, Enforcement, Andrew Bigart, Payments and Regulatory Attorney, Laura Biddle, Banking and Regulatory Attorney, Josh Raymond, previously on Capitol Hill, Government Affairs Specialist, Attorney and Partner, Gerry Sachs, formerly of the CFPB, Enforcement, Policy, FTC, State Attorneys, Federal Department of Justice, U.S. Attorney's Office, and Peace Corps. And myself, Jonathan Pompan, and welcome. Thank you. So without further ado, I think we should get into discussion on the bank-fintech partnerships. There is really no shortage of buzz about the collaboration that bank and other fintech opportunities are providing, but there's also threats and a variety of regulatory issues, some of which are new, but many of which are continuing from the year before. To lead us into that discussion, Laura Biddle, my partner, will cover a little bit about what is really the sort of quintessential issues of bank-fintech partnerships, but also take a step back and explain why they're relevant in the first place.
Thank you, Jonathan. Welcome. In the bank-fintech intersection, I think 2019 did not bring a bank charter for a fintech company. Full or special purpose, the OCC special purpose national bank. For full depository institution charters, the National Bank and Industrial Loan Company are really the only options. The states and the OCC are definitely willing. the OCC having approved a full national bank charter for a fintech company, conditionally approved, but the FDIC, as the deposit insurer, has yet to grant deposit insurance. Currently, the FDIC has 21 pending deposit insurance applications. 6 of those are for fintech companies looking to establish banks.
And Laura, is there a timeline at all for that process? To some extent, for the last 2 to 3 years, there's been a lot of buzz about these opportunities. So some of these applications have been in for a little while, not that long. But when do we expect to see, if at all?
Well, we would hope to see something soon. There's no definitive timeline. One thing that Chairwoman McWilliams has been promoting is transparency in the agency, so you can see when things are filed and when things are approved, what's been withdrawn, what's been denied. For example, the only full-service national bank charter applied for by a fintech, Barrow Money, first filed its charter application in July 2017. It received conditional approval from the OCC in August 2018, but after filing, withdrawing, and refiling its deposit insurance application in July of last year, that still remains pending. Usually these things are done, a lot of it's done behind the scenes before the application is actually final, before the application is final and it becomes public knowledge. But with these fintech charters, these new charters, there's a lot of give and take back and forth with the agency, so that particularly with the FDIC, to make sure they get it right. The other option is the industrial loan company charter. 5 pending applications, all are fintech companies. It is a controversial charter because it can be owned by commercial firms. The last charter was issued in 2008. There was a moratorium resulting from the Walmart transaction, or interest in getting the charter. Again, Chairwoman McWilliams has expressed support for the charter, and hopefully there will be some movement on the deposit insurance backlog this year. There is some opposition, including a Senate bill that was introduced in November that would prohibit commercial firms from owning ILCs. Special Purpose National Bank, the OCC's charter, or a non-depository fintech charter, they began accepting applications in July of 2018, but there have been no takers, largely due to the pending lawsuits. One, the Conference of State Bank Supervisors, and the other, the New York Department of Financial Services, both challenging the OCC's authority to issue a charter to a bank without deposit insurance. Both suits were originally dismissed, but were refiled after the OCC began accepting applications. In September, the D.C. Federal District Court granted the OCC's motion to dismiss the CFPB suit due to lack of standing and rightness. For the New York DFS suit, the District Court issued a final judgment in favor of the DFS in October, and in December, the OCC appealed to the Second Circuit. So I think that is something we can definitely watch for in 2020, and could ultimately be resolved at the Supreme Court.
Right. So, Laura, that's currently non-banks that want to become banks, more or less. Get the benefits of a bank charter, FDIC insurance, and whatnot. Now, bank-FinTech partnerships are also working the opposite direction, too, although depending on what court you're in, or maybe what state and who's looking at the loan docs, they might not think that that's actually who the true lender is. But in any event, there are banks partnering with non-banks because banks want access to the innovation and the capacity of those non-banks. But then for those that are doing lending, there's a variety of issues that come about, oftentimes boiled down as valid when made and true lender, 2 distinct concepts, somewhat interrelated, but how are they different?
They are different. So the valid when made doctrine provides that if a loan is non-usurious at the time it is made, then the loan does not become usurious when it is transferred or assigned. So this has been around for over a century. The Supreme Court weighed in way back when. This was, as we all know, upended by Madden versus Midland Funding in 2015, and it's still the law in the Second Circuit. There have been some attempts at a congressional fix, but it hasn't gone anywhere. And in September of this year, 26 senators actually sent a letter to the OCC urging them to provide an administrative fix, believing that the uncertainty created by Madden, and I quote, hinders the efficient and effective operation of credit markets and impedes financial innovation. In response, in November, both the OCC and the FDIC codified the valid when made doctrine, specifically providing by regulation that interest on a loan that is permissible under the relevant banking statute shall not be affected by the sale, assignment, or transfer of a loan. So by codifying the doctrine, Madden-type decisions would presumably be preempted, although I think there are some that are skeptical that will solve the problem in the end, and it may still need a congressional fix. So moving on to the true lender, one thing the OCC and the FDIC specifically did not address in their issuances was true lender. That's the doctrine that provides that the entity that makes the loan is the true lender, even if the loan is thereafter transferred or assigned. So this has been tricky for the bank-FinTech partnership model because Madden has been cited to challenge marketplace lending arrangements or secondary market loan sales where loans are sold soon after origination. In a minute, and Andy will talk about the lawsuits a little bit, but just want to say that this is still very much front and center. The full House Financial Services Committee on January 30th will hold a hearing on rent-a-bank schemes and new debt traps, assessing the efforts to evade state consumer protection and interest rate caps, and that's sort of where the litigation really comes in.
Yeah, so this is Andy. Thanks, Laura. To add a little color to what Laura was talking about in terms of the litigation, the way I view true lender is essentially invalid when made, right? The argument would be that you have a partnership between a non-bank fintech company and a bank. They have a mutual interest in working together, largely because the bank often doesn't have the flexibility from its own regulator to develop innovative underwriting systems that non-banks may have access to or may have come up with. Meanwhile, the non-bank doesn't have access to preemption. So they, if they're operating under 50 different state licenses, they'll be bound by state usury laws. They can't export rates and so on and so forth. So there's a mutual interest in working together. And courts know this, litigants know this, plaintiffs' lawyers know this. So what you often will have as a result is a loan that's well above state usury laws. And these can be simple consumer installment loans, they can be business loans or whatever. And the way that they're able to accomplish that is the bank and the fintech company will partner up. So what litigants have attacked this for various reasons, largely just because of violation of state usury laws, and what courts have looked at, it's really all over the map. There's some courts who have just looked at the lender of record whose name is on the note, ended the discussion there. That's consistent with traditional valid when made doctrine, where if a bank is actually lending the money, the bank is the creditor on the note, then it's a bank loan, it's valid when made, and so on. But other courts, and largely a consequence of clever plaintiffs' attorneys, have really started to dig into who has the predominant economic interest in the loan. Another aspect of these constructs will be that the fintech company will take the applications, they'll do much of the origination work, the bank will paper the loan, and then immediately the fintech company will buy it back. There are some issues that have been raised in courts. There's a case against Cash Call, there's various others, where a mandatory buyback of loans a second or a day or a week after they're originated was viewed as problematic because the courts found that the bank itself did not have any real economic interest, any risk of loss in the transactions. So, several of us work with companies structuring these types of transactions or these types of arrangements. And typically there's some interplay between participation interests and, again, some doctrine there. If there's not a whole loan sale, there's a participation interest. How much is it? Is it mandatory? Are there other parties that can take a participation, and so on? And the landscape continues to evolve. What we found, and I think this comes back to Madden, is that often bad facts make bad law. That's an old law school adage, which I think is true. Courts that are very pro-plaintiff or they're sympathetic are more open to hearing arguments about who has or does not have a predominant economic interest in a transaction and might be more willing to unwind them. And you also have great inconsistency across different courts and different circuits.
And you have significant issues in some cases, depending on the state, with collection strategy, particularly using third-party collectors.
That's right.
Or in a debt buying scenario or secondary market investments where maybe a lender and the fintech partnership can weather whatever the storm is initially, but then if they want to go to the secondary market or if there's a debt buyer that's doing diligence, there's a more robust review of those materials, and the risk versus the reward comes into play. And then you actually even have, sometimes we've seen state law issues where the state lending law that applies to the debt buyer would be different than the law that would apply, of course, to the original lender or to the loan. And this all, of course, manifests itself in marketplace loans and small dollar loans and where a lot of the action is these days. So now, Laura, with the banking agencies, there's been some trends. Certainly in 2019, there was actually quite a lot of announcements. And then in 2020, we're expecting a couple to actually maybe not come 100% all the way to the finish line, but at least hopefully close.
Great. So yeah, there were a significant number of proposed and final rules issued in 2019, many aimed at easing regulatory burden for community banks. To watch in 2020 are two proposed rules issued in December that provide potential bank fintech opportunities. The proposed rules attempt to modernize regulations for decades-old statutes whose frameworks don't reflect the technology and the expansion of interstate banking over the past 25 years have transformed the financial services industry and how banks deliver their products and services and how customers choose how they want to bank. And the first of those is the Community Reinvestment Act of 1977. One of the biggest challenges with the CRA is determining what actually qualifies for credit. Sometimes you can spend time and money, particularly with an investment product or service, only to find out that it doesn't qualify. The rule aims to provide transparency, including clarifying what actually constitutes qualifying activities. And then to make it easier, the agencies would publish and periodically update a list of qualifying activities. So we see, so while there's a lot of support for the modernization, there's also plenty of opposition, including the Federal Reserve, which did not join the OCC and the FDIC in the issuance. Yesterday, the House Financial Services Subcommittee on Consumer Protection and Financial Institutions held a hearing reviewing who wins and who loses with the proposed rule. So we see the rule, or the proposed rule, really as sort of another advance notice of proposed rulemaking, which the OCC had issued earlier in 2018, and not an NPR headed for a final. But regardless, the OCC and the FDIC have taken a stake or put a stake in the ground, and that is transparency. And this will provide opportunities for banks and even non-banks. We see regulated non-banks trying to put together investments and products and services that banks will be able to use to serve low and moderate income persons and to meet their CRA obligations, but then are reluctant to participate due to the uncertainty with respect to whether the activity will qualify for CRA credit. With more certainty as to what qualifies, before time and money are spent, fintechs and others will be able to structure investments, products, and services that will assist banks in meeting their CRA requirements. So it's sort of a win-win for both, as well as the the communities that the banks serve.
It could be a real shot in the arm for the nonprofit counseling and social services communities, particularly those that have nationwide footprints and sometimes aren't able to take advantage of some of the locality aspects of CRA grants.
In addition to clarifying what qualifies, it's also one of the other proposals is to expand the CRA assessment area to include areas in which the bank not necessarily is located, but where it takes a significant amount of its deposits.
Yeah.
So that'll also hopefully cover more areas as well. And the other one would be the rule on brokered deposits. Without going into too much detail, brokered deposits have somewhat of a negative connotation. Banks that are not well capitalized can't accept them, and brokered deposits generally carry a higher deposit insurance assessment rate. The FDIC has broadly defined deposit broker. There is an exception for persons whose primary purpose is not to place deposits with the bank. This has been difficult to use in the past. There's years of interpretations. They're hard to implement or to understand, and most of them are based on outdated business models. What the proposed rule does is provides more clarity around the exception and the interpretations, and rather than providing just a mechanism for a bank to get approval of an exception, it provides the opportunity for the deposit or the supposed deposit broker to get an exception. So that way, instead of the deposit or the non-deposit broker in this case, with the exception, will be able to go from bank to bank to bank, show their exception, and be able to the bank will be able to accept their deposits without the concern. Currently, the way that works is the bank has to do it. So every bank that the deposit placer goes to would have to get their own exception.
Well, thank you, Laura and Andy. And the future of the Consumer Financial Protection Bureau has largely been in the news and in some areas in doubt since its inception. And while there's no shortage of proposals, critics, and commentary on what to do with the CFPB and how to restructure it, at least for now, particularly at the tail end of 2019 and going into 2020, at least for the first 2 quarters, a lot of the attention is on the lawsuit involving CLO law. And that lawsuit is one that is related to a challenge of the CFPB's leadership structure and could have, at least in the short term, some very interesting collateral consequences, both for those who are before the CFPB now and then going forward with respect to its structure, although to some extent we have this sort of other aspect of the timeline happening here, which is a presidential election and a possibility that all could be for naught in any event. So to break it down, just the basics, I'll turn it over to Allyson, and then I know, Andy, you've been following along as well, too, and certainly Gerry.
Yep. So as everybody on the phone undoubtedly knows, good afternoon, I'm Allyson Baker, and as everybody undoubtedly knows, the Supreme Court is intending to hear oral argument on the CELA law case on March 3rd of this year. And it's a case that everybody is kind of anxiously waiting to find out more about. We expect an opinion from the court probably toward the end of the term in June. It's one of the big cases. In a nutshell, the question is whether or not the provision in the Consumer Financial Protection Act, which enables the president to remove the director only for cause, is constitutional to the extent that it violates core separation of powers principles. So the idea being that should it be the case that there's this agency out there that isn't susceptible to a change in administration? That's in a nutshell the case before the Supreme Court. It's not dissimilar from some of the arguments that now Justice Kavanaugh, previously Judge Kavanaugh on the D.C. Circuit ruled in the PHH case, which of course went up to the D.C. Circuit en banc. And similarly, at least in the panel decision in the D.C. Circuit, Judge Kavanaugh found that there was a constitutionality problem with the for cause provision in the Consumer Financial Protection Act, but The other issue here is, even if that is the case, it doesn't necessarily invalidate the entirety of the agency's existence. Rather, what Judge Kavanaugh, now Justice Kavanaugh, held at the time was that it was severable, so that you could take that component of the statute out, redo that component of the statute and have it conform to a certain constitutional principle without eliminating the agency itself or any of the core things that the agency has done. And candidly, I think there's a certain amount of expectation that if the court rules in this way, there probably won't be a huge amount of legal disruption as the CFPB is concerned. But I make a distinction between legal disruption and kind of political or practical disruption.
A lot of noise.
Yeah, a lot of noise. Exactly, Jonathan, a lot of noise. But as a practical matter, I don't know if, assuming that severability component holds up in court, and there's reasons to think it likely would, given the composition of the current Supreme Court, it seems unlikely that you're going to have a situation where the Consumer Financial Protection Act is completely gutted, the CFPB goes away, all of its rulemaking that it's inherited from the Federal Reserve goes back to the Fed, and all of its prior enforcement activity is null and void. That just doesn't seem likely to happen. It's going to be a much more incremental situation in all likelihood, and there is a lot of noise, but the practical implications of it, I think, are probably more that the perception of the Bureau's ability to enforce the law is potentially compromised a bit because people see it as being weakened by this challenge. And my colleagues, Andy and Gerry, both of whom served at the Bureau with me and were part of the effort to stand it up, I'm sure have opinions as well. And I'm curious about what you think, Gerry, and what you think, Andy, as well.
So thank you, Allyson. It's a fascinating argument because, I know with the PHH case, there were many people who thought surely there's no court that's going to find part of the CFPB's enacting statute unconstitutional, and then of course that's exactly what happened. Of course, the full D.C. Circuit reversed that opinion, so it is not currently the law. But the Sala case, if you read the amici briefs, there are a variety of opinions on what should occur, whether it's striking down the for-cause provision and allowing the director to stay in place and nothing really changes, or part of the arguments are that you can't do that because if you look back to when the Dodd-Frank Act was written, the crux of it was to have an independent agency that could take and make decisions about financial markets without being beholden to politics. And so if the director is removable for a cause at the whim of whomever's in the White House, then that sort of guts that initial legislative intent. Now, of course, there's also the argument that, well, nothing needs to be changed, that it's just fine, and that the theory that there must be sort of this unitary executive is not necessary or not valid, and nothing should occur. So, without a crystal ball, I will make no predictions as to how it comes out, but it is fascinating to see differing opinions within the business community itself, because there are a large number of businesses that say, gut the entire agency and throw all of its regulatory authority back to the previous regulators, that would be just fine. And there are many, for example, in larger industries that were drastically affected by the Dodd-Frank Act and have spent millions of dollars coming into compliance, who are saying, no, please don't do that.
Or they've now, particularly large financial institutions, they've reached a rapport with the CFPB examiners. They're comfortable with CFPB being one of their regulators and really would not prefer more disruption where everything gets reshuffled again to who knows where, right? That's a big consideration for the industry, whereas some of the non-bank community would love to not have a federal regulator at all.
Yeah, but on the other hand, you're on the cusp of new debt collection rules to modernize the FDCPA, and there's a whole host of other areas where industry had essentially been waiting for, in some cases, decades for somebody to come in and make some enhancements, adjustments. There are some winners and losers, and certainly for the first several years of the CFPB, many would say that it wasn't working out so great. But now, a little bit of the different politics. Now, what's really interesting, though, is there also are other issues involved here, too.
No, so back to the sale law case, a couple of things that Gerry had mentioned that I just wanted to add a little color on. One, there is an argument, and I think this was the argument that Elizabeth Warren and others made when they were creating the CFPB, that basically having the director completely independent and removable only for cause was extremely important. A similar analogy could be made to the ACA mandate, right? That without it, the whole law falls apart, because the CFPB needs to be independent and can't be subject to political whims and political pressure and so on. So that is there in the background, the litigants attacking the CFPB's constitutionality and arguing that the for cause provision cannot be severed or seizing on that, and we'll see how it goes. We know how Justice Kavanaugh at least ruled when he was on the D.C. Circuit. There's reason to believe he'll take the same approach, but we won't know until it happens. The other thing, Gerry touched on the unitary executive theory. My view on the long play here and what this will mean if it comes out the way that we all anticipate it may, which is the structure is declared unconstitutional, but the for cause provision is severed. That essentially brings the CFPB under basically the same governing rules as any other executive branch agency, where the director is basically serves at the pleasure of the president and can be removed for whatever. This comes down to a theory that all executive power rests in the president, that Congress does not have the authority to create an independent agency that doesn't fully answer to the president. That will be the long-standing precedent, I think, if it ends that way. It will hamstring Congress's ability moving forward to create other independent agencies or other quasi-independent or independent agencies or other types of authorities under its legislative power.
So there's a certain irony here that, we're all kind of watching as well, which is if the election goes to a different party, including one of the candidates who's running who founded the CFPB, this idea of a unitary executive may be less appealing to some of the proponents of this case. There's a certain interesting aspect to this, which Andy just touched on, which is how the Bureau has kind of been amplified as, kind of an example of a larger political fight that's been going on, and the real politicalization of the Bureau. Just yesterday or 2 days ago, there was the members of the Congress, Democrats in the House, wrote a letter to the OIG, the Office of Inspector General of the Fed, about how the Bureau had not been adequately imposing restitution remedies in its enforcement actions, and asked that the Office of Inspector General at the Fed, which oversees the CFPB as well, do a review of that. And it's just this assertion that the current leadership at the Bureau isn't as consumer friendly as the prior leadership, and it's really more about politics, and it's just interesting to watch. And to those of us who were there at the time when the agency started, it's somewhat fascinating and somewhat perplexing at the same time.
And it's also very interesting that Director Kraninger has taken the position that the Dodd-Frank Act is unconstitutional in this aspect.
Yes.
And that the for cause provision should be severed, and that's the Bureau's official position. But at the same time, they are continuing with enforcement activity, supervisory activity, rulemaking activity, and so nothing is stopping or has stopped the Bureau. I shouldn't say nothing. In most instances, the Bureau has been able to continue. There are some, court cases where stays of litigation have been issued and other things to await the Supreme Court's outcome in this matter to see how it would affect things. But that is more of a rarity than the norm.
Right, and then just this week, the CFPB came out with a published petition to quash response from Director Kraninger, where she said flat out, we think you need to comply with our CID, despite the fact that CELA is ongoing and that we've taken this position in court. So everybody's trying to have their cake and eat it too, and at the end of the day, the short of an absolute evisceration of the CFPB, the interesting thing is that probably whether you have a re-election of President Trump or a new president, both administrations could potentially take the position that the director works for them and they get to pick who that director is. And so much power has been delegated to the Bureau that it'll continue to be the hot potato that it is, more or less unlike some of the other agencies where you've got, a 3-2 splits like at the FTC, where the politics, while there certainly are some, have been essentially elevated to still at the congressional level as opposed to using the agency as the pinball. So, Well, we'll have to see. Certainly it does have impact, though, for those who want to forestall investigations or enforcement or maybe in court. There's no shortage of folks that are trying to delay or use CELA as a lever.
And there have been some courts that have declined to allow litigation to move forward that the Bureau's brought. One in the Eastern District of New York, where I think it's the Forster and Garbus case, where they said, we're going to stay the case pending disposition of the CELA case. One of the things that comes up a lot in my practice, as it does in my colleagues' practice, is the question of how much of the fact of CELA law you use when you advocate or negotiate, for example, with the enforcement office. And my counsel on this point is usually you can drop a footnote in your NORA response, but don't piss them off. And I think that what we see with the In Re Equitable Acceptance Corp application, you kind of see the Bureau fighting back and saying, I hear you, but even if reseverable, your CID is still enforceable. It's not self-executing. We'll go back into court if we have to, but don't test us.
Right. Reading the tea leaves is important.
Yep.
So, despite what has been for the last 3 years, a lot of buzz about enforcement slowdown in some quarters, the reality is that's not been the case. There may be a shift from regulation by enforcement. So we are seeing a difference in sort of the tenor of the enforcement settlements and pronouncements, but certainly no shortage of investigations, as shown by the equitable petition response from this week, as well as also our own practices. There's just no shortage of CIDs flying around, but there's also very active conclusions to cases either through litigation or enforcement settlements. So, Gerry, what would your bottom line take be as to what's happening at the CFPB these days?
So, during the Trump administration initially, and when Director Cordray resigned his post, enforcement did substantially slow down. There was ongoing litigation, but there was definitely a slowdown. In 2019, with the full sort of first year of Director Kraninger in her position, enforcement investigations have restarted. So we have seen across all financial services markets, services and products markets, that CIDs are going out and companies are responding to them. We have seen a number of lawsuits, including those with ex parte TROs and preliminary injunctions being filed in federal district court. We've seen coordination with the states, especially those in areas such as California and Illinois and New York and Pennsylvania, where there are a lot of former CFPB enforcement attorneys who are leading or have substantial roles in those offices. We've seen a lot of coordination at that end. And Director Kraninger has been pretty clear that examinations should continue. And so we have seen a lot of CFPB examinations continue. We have seen entities become more comfortable with CFPB examinations, but we have also, through our experience, seen a number of surprises. The CFPB examinations are not exactly akin to those of the prudential banking regulators. There are some differences, and there are different manners and mechanisms to work through those examinations, which I think is often important. Director Kraninger has made no sort of, and she hasn't made it hidden as to what her priorities are necessarily. She's spoken publicly about them. It seems pretty clear also based on CFPB's enforcement activity that if you're offering products or services to any vulnerable populations, you should be careful. One that is a hot button, and rightfully so, are service members. Service members tend to skew towards a younger population just by the nature of our military, and so sometimes those military members tend to be less savvy consumers, and so the CFPB has taken a very strict stance on it appears on prosecuting anyone who works with service members and does not adhere strictly to all of their legal mandates. I would also throw into that bucket older Americans and other protected classes. We have not seen any enforcement actions with regards to fair lending in 2019, if my memory serves me correctly, which was something that we did see more of in the previous CFPB administration. But other areas of focus that are listed on our slide, I won't belabor everyone who's listening to read them to you, but these are general areas that we have seen activity in. And the CFPB still, and some of it may be residual, but they residual litigation, but they are not afraid to litigate. There have been a number of court decisions that have not been favorable to the CFPB. A number of them have found that the CFPB did not prove consumer restitution or consumer harm, or that in balancing the equities in determining restitution, for example, the CFPB could not obtain both restitution and a civil money penalty, giving consumers a windfall. So it will be interesting to see how the enforcement, litigation, and investigations progress in 2020. I would not anticipate a standstill. There may be some changes, though, because as has been reported in the press, there may be a new enforcement director coming to the CFPB, which is notable because the current CFPB enforcement office, all of the senior staff are still residual senior staff that were there either at the very beginning of the CFPB or came in under Director Cordray. And so time will tell as to how that goes forward. And Andy and Allyson, if you'd like to chime in as well, please.
Yeah, I have a couple of other observations to complement what Gerry said. So what I've seen is a couple of things that I think are really noteworthy and unique to the Kraninger administration. One, we're seeing civil investigative demands that are far more defensible in court. They're narrower in scope. They're more linguistically precise, which I think is helpful to companies that receive them. They're more likely to seek information that is clearly and causally linked to the potential violations of law. And the upshot of that, I think, from an enforcement perspective, is they make them a lot more likely to carry real weight and to be really serious CIDs. Not that it was a walk in the park previously, but when you see something like that, they look and sound and feel a lot more like Federal Trade Commission civil investigative demands, or even non-administrative subpoenas and administrative subpoenas that the Department of Justice has historically promulgated and served. And so I note that that's one change. There's another change that I think is kind of a belt and suspender issue, but really material, which is consistently now when a company gets a CID, almost immediately as you start negotiating the contours of your response, you get asked to fill out or complete a tolling agreement. And this is a process that, started a little bit under Cordray and then kind of went in fits and starts under Mulvaney, but almost to an investigation now, within a month or so of receiving a CID, I'll get asked if my client will execute a tolling agreement, which is basically an agreement that stops the statute's timeline from running. And inevitably, you execute it because you don't want to put the Bureau into a place where they feel like their back's against the wall and they have to go into court. But I think it's curious that has become part and parcel of what they do. That was not the case a few years ago. And then the other thing I'm noting is that the CFPB continues to have a fair amount of turnover in its staff in the enforcement office, but some of the more senior people have been there since the beginning. They're people that we know from our own practice and having started at the Bureau, and they are continuing to have a fair amount of say over how that office works. And I don't expect that that's going to really change, even if Kara Peterson, who's the current acting director, is no longer acting director. I still think you're going to have some of the folks who were there at the beginning, who were in deputy roles, stay in that role. So those are some of the big kind of mechanical or seemingly ministerial but mission-critical issues that I'm continuing to see at the Bureau's enforcement office. I also see a fair amount of collaboration still with the attorneys general, less than maybe you had under Cordray, who was really himself a former AG, but there's still a fair amount, especially in the student lending space. All aspects of student loans, I'd say, are really hot. And that's, one of the areas that we continue to see a real uptick in activity in.
And as a practical matter, the reality is that experienced staff now is probably in large part contributing to those more narrow or more defensible CIDs. Query whether or not they're any easier to respond to or to address from a defense standpoint, but nonetheless, it's a lot easier to respond to a less document request than ones that are maybe more narrow than one that's looking for every document that you've done since the beginning of time, which is certainly what we used to see when you all first started.
That's right. Yep.
So, FTC still plays a major role in consumer financial services, whether it be actually directly connected to consumer financial services and activities through the Division of Financial Practices at the FTC, or just generally with respect to advertising and marketing practices, where there's been largely no abatement at all in the last 3 years, despite the change in administration and change in leadership at both the FTC commission level and at the staff level at the Bureau of Consumer Protection. And in fact, actually, some of the largest settlements and most noteworthy enforcement actions in the history of the Bureau of Consumer Protection have occurred in recent time. We expect to see more of that. Gerry, from your perspective, having been on the inside and now on the outside, what are you seeing?
So it's very interesting. The FTC, for the first time in a while, has a full commission. It has 5 commissioners, 3 Republicans, 2 Democrats, and it has a lot of staffers who have gone back and forth from the FTC to the CFPB, now some back to the FTC. And it has some people who have come from the states up to the FTC as well. So it is filling up its staff, and it, as you noted, Jonathan, is moving forward. Notably, and a lot of this is publicly available on the FTC's website, they are doing a very good job of keeping the public aware of what their priorities are and where they're going, at least to a certain extent. The FTC is very privacy and data security focused when it comes to consumer protection. Anyone who's on this call who's following privacy or data security is definitely aware of the $5 billion privacy settlement. Probably also aware of the FTC making it clear that they are viewing privacy through its traditional lens and how they look at consumer protection through UDAP and otherwise. What's interesting is the chairman of the FTC has come out publicly and said that it's necessary and there should be a congressional legislative fix to address the FTC's ability to more comprehensively regulate privacy. But the takeaway is the FTC is very interested in privacy and data security. So to the extent you have consumer private information, you need to safeguard that. And data security is nothing new, but it is just a reminder that you need to be prepared for a data breach. Not necessarily will there occur a data breach within your company, but when will you be targeted and when will a potential data breach happen? And of course, having compliance management systems in place to manage that, to monitor, to evaluate, and of course to keep up with industry standards as they change.
And that's been a big area. In fact, actually, just recently in a blog posting that they really emphasized FTC that in their orders now they're becoming more prescriptive in terms of what kind of conduct they want to see to remediate or avoid those issues in the future, and essentially signaling as to what those practices are supposed to be. Not all that different, actually, than the CFPB settlement orders that historically have been far more prescriptive than the FTC orders. FTC is sort of catching up in that regard in terms of how many details they're looking to put out there in the marketplace, not just obviously for the parties to the agreement, but for anybody who wants to be following what may or may not be perceived as, quote, best practice. Gerry, there's another sort of interesting thing happening here, though. FTC may be going full steam ahead, but as a result of that, there are some companies that have had their backs against the wall in enforcement litigation and have actually been challenging the FTC's authority with respect to remedial action that they can take. What's that all about, and should anybody take that to the bank?
So that is a very interesting point, and there's been some interesting litigation around that. But before I jump to that, let me just touch on briefly that to the extent any business touches or handles information relating to children, obviously that's a very sensitive area for the FTC, and the FTC has put sort of a concerted effort forward and to make it publicly well known that if you're dealing with endorsements, certifications, influencers, or consumer reviews, you basically have among others, but two very, for this webinar purpose, two short things that you want to make sure you're doing are that you're disclosing any connections with your business and with those endorsements or certifications or influencers or reviews, and that they're truthful and accurate. seems pretty basic, but it's something that the FTC has put out there very publicly. The other area that's worth note is the FTC has not shied away from taking action against fintech or payments companies, and I know we will talk about that in just a little bit. But what's arisen out of, quite frankly, a shift in the judiciary, but also litigation against the Federal Trade Commission, are two interesting theories. The first is that basically the FTC statute does not give the FTC any authority other than to get injunctive relief, that they can't get anything but injunctive relief. They cannot get restitution or disgorgement or what's known as ancillary relief or ancillary equitable relief from the courts. The Seventh Circuit upheld that and basically said that the FTC can get injunctions, nothing more. The FTC is in the process of seeking cert on that. There has been a number of suits filed seeking declaratory relief in the Seventh Circuit, but as of now, that's the only circuit that has found that way. There are a number of cases going in the Ninth Circuit, the 11th Circuit, the Second Circuit, all pushing this theory forward. There's also another theory that prevailed in one circuit and has been brought up in various other circuits, which is that the FTC's jurisdiction to sue in federal court is limited to only ongoing activity or activity that is about to occur, and so that the FTC has no jurisdiction within its federal court litigation authority to seek redress for past wrongs, and that they would have to do that through their administrative process. Again, that's sort of an area to watch in 2020 to see how that progresses, and it will be interesting to see what 2020 brings for both in terms of FTC and CFPB enforcement activity.
And a couple things to be on the watch for. At the end of the year in December, both the FTC and the CFPB had a joint public workshop on the issues affecting the accuracy of both traditional credit reports and employment and tenant and background screening reports. That is an area that the FTC has historically focused on, and particularly the tenant and background screening report piece. Obviously, consumer reports now largely fall under the auspice of CFPB. But that joint workshop, certainly placed signals where we had quite a few instances where there's likely that there'd be some sort of background investigations happening, if not already, in the future, and then lead to scrutiny and potential enforcement. So for folks in those spaces, something to be on the watch for. And then the FTC also has been signaling quite an interest in small business financing. They've done that in several public settings, as well as also through a forum that was hosted last year. And so again, likely to see the fruits of that in 2020. And CFPB, while investigations are non-public and confidential unless the target of the investigation decides to disclose it, actually through a number of petitions to quash or modify CIDs, there's several areas that are known to be of particular interest and under investigation. Deferred interest credit cards, tax and debt relief, student loan debt relief, lump sum payments for military pensions. There's the service member issue again, and debt collection. So at a minimum, those are investigations that are public. Presumably, Kraninger is wanting that information inbound so the enforcement attorneys can digest it and decide if they want to move forward, potentially see some developments in that area in 2020. Now, Gerry, Andrew, Allyson, there's also been quite a few state-level activity in 2019, and we expect to see in 2020. We note a couple here, and in particular, I want to highlight really the trend that has really sort of come to the forefront of the news in the last week and a half, and that is this concept that I suppose you could kind of say Pennsylvania pioneered this, although perhaps at a smaller scale in hindsight. But this idea of creating mini CFPBs not necessarily always from whole cloth, but in California, changing the Department of Business Oversight, which had formerly been the Corporation Commission, and financial institutions blended together. And then in New York, turbocharging and enhancing the Department of Financial Services. Now, interestingly enough, though, both of those states are well known for already being active in consumer financial services enforcement, as well as also in particularly in consumer lending, have some very strict laws already. So it's not going to necessarily it doesn't mean it's going to get any better for anyone. And in some cases, some people aren't playing in those spaces. But, for some quick takes on that, turn to Allyson, and then working Andy and Gerry.
So Pennsylvania did start the trend. The Attorney General in that office did start by creating a so-called mini CFPB that's actually run by Nick Smith, a former colleague of ours from enforcement at the CFPB. He and I were office mates. And similarly, the Department of Financial Services, kind of following in the Ben Lawsky tradition of being very aggressive, has decided to siphon off a part of its office run by a former prosecutor who oversaw mortgage fraud cases at the Department of Justice, and create a mini CFPB enforcement office as well, if you will. And, as a practical matter, I think there's two big issues here that matter. One, it's sending a very loud political message to folks around the country that even if there's a potential argument that the CFPB is in retreat, the states are not, and New York and California in particular, very large markets that they examine and supervise, and that you better be careful because we'll come for you, and we're going to come for you with former CFPB people and former Department of Justice criminal prosecutors. So it's not the game, if anything, is getting more serious, not less serious. I think that that's one practical outcome. I think the other outcome is that there's a concentration of resources in those offices devoted to enforcement efforts. The Department of Business Oversight does have an enforcement arm, but it hasn't been the most robust enforcement arm in that agency's, toolbox, if you will. It hasn't been the most robust component of what it does. And it's clearly trying to send a message that, look, we're going to try and mimic and act more like the CFPB did. Curiously, it was Rich Cordray who apparently drafted the proposed legislation now making its way through California's legislature that would basically enable the DBO, the Department of Business Oversight, to have a type of mini CFPB. And again, I think those are the practical implications. To Jonathan's point, these are large, very large states. They have very large markets that they supervise. Any viable financial concern in this country does business in California, does business in New York, most of them, not all of them. And it's pretty hard to avoid those states and to avoid the reach of their laws. And so this is just really sending a message out there, watch out. I'm not sure it materially changes anything from a legal perspective.
Go ahead.
What's interesting about Allyson's point is, I take away two things. One, Rich Cordray is well aware of all the deficiencies in the Dodd-Frank Act, so you can assume that the mini CFPB Act in California will be well written. The other thing is that a lot of businesses or clients that we have sometimes will hear, we can stay out of New York, or we can stay out of California. But as you start to see, and here's where I think it gets interesting, as you start to see more states create mini CFPBs, the question for me will be, how close are those laws and similarity, and how well do they coordinate? Because we've started to see more coordination among the states, and if that occurs, then it will no longer be, well, we can stay out of just California, or we could stay out of just New York, because the major markets may all start to coordinate, the states with the higher population concentration, and that could on its own start to regulate across the country. And it really shouldn't surprise anyone. The federal law has always been a floor, but very rarely is it a ceiling.
Yeah. The only thing I'd add is the states, particularly these blue states like California and New York, we're looking to the CFPB for guidance and leadership when Cordray was there. I think now there's a disconnect between the two. And what these states are starting to do is that to Allison's point, they're starting to see, or they're anticipating a retreat at the federal level and taking matters into their own hands. And, sometimes that's a small state like Vermont that it's relatively easy for clients to avoid. When it's California and it's a third of your market, it's almost impossible if you want to continue to make money. And this goes beyond just mini CFPBs. There's also laws like New York's cybersecurity initiative or California's CCPA, where they're essentially imposing their will as a best practice on the rest of the country, rather than a federal agency doing that and going through federal notice and comment rulemaking. You're in a position now where you essentially have one state saying, if you want to do business here, you're going to follow our rules. And companies across the globe who do business there are building out their infrastructure to cover everywhere. Because if you have to comply with CCPA in California, you may as well comply with it across the board.
No shorter of complexity there, and certainly things to keep an eye on, particularly the gap plugging in substantive law, not just the process stuff, like debt collection and others, where there might not actually be licensing and supervision in these states yet. So with payments, it's a dynamic landscape. Andrew, you're in the middle of it every day. I don't know how you keep track of the different combinations of processors out there, but the reality is that there's been consolidation there, but there's also been legal and regulatory shifts too.
Yeah, absolutely. And over the next few slides, we'll just touch on some payments developments very quickly. I think looking back over the last year or two, one of the big developments has been a lot of consolidation, at least with the top line payment processors and others, whether FIS WorldPay, Fiserv, First Data, and Global Payments and TSYS in terms of the combinations there. But while that's been happening kind of at the top of the payments ecosystem, we're also seeing a lot of innovation and new companies getting in through the payment facilitator model, where essentially you have software companies looking to add payments into their suite of services that they provide to their customers, and basically getting started that way. So there's a lot going on in that respect, and I think that's going to continue really in terms of the growth of payment facilitation as being a popular model through 2020. Another area just in terms of kind of industry developments that we expect to see grow in 2020 is the increasing use of push-to-card payment technology. And that's really, it's a technology a lot of the card brands have rolled out in the past few years, which allows a payments to basically push payments through the card brand networks to a card holder. So in other words, a payor can send funds through the card networks for purposes ranging from P2P, money transfer, funds disbursement, bill payment, among various other uses. And we're really expecting that to start to take off in the next either this year or shortly thereafter. ACH processing continues to be an area of growth. We're seeing a lot of growth as well in the area of third-party senders. Those are the types of payment companies that really act as an intermediary between the sponsor bank in an ACH payments program and the customer that's looking to send payments. That might also be an area where we'd expect to see some additional scrutiny in the future. As some of you may have read in newspaper articles, there was a payment processor, presumably a third-party sender, that was alleged to have run off with, I think, about $30 million in New York in terms of wage payments that were owed. So that could be an area that could get some increased scrutiny moving forward. In terms of what are some of the legal and regulatory topics to keep in mind from the payments perspective, well, a lot of them are really the ones that we've been keeping an eye on for the past several years. Bank Secrecy Act, anti-money laundering is always going to remain important. Capturing information, the beneficial ownership issue, which a lot of payments companies had to deal with over the last year or two, continues to be a key. Money transmission is always a challenge in the payments industry. Money transmission, of course, is regulated at both the federal and state level and is broadly defined as the acceptance of currency or funds from one person for purposes of transmitting to another. You have to register at the federal level if you're engaged in money transmission, and you have to obtain licenses in almost every state. That is one area where some of the state challenges, there have been some developments, the Conference of State Banking Supervisors trying to improve kind of some of the streamlining the application processes and other areas there. Data privacy and security is always important, as Gerry mentioned previously. And then consumer protection. I think as most people know, whether the FTC or the CFPB, they've been pretty aggressive in going after payments companies that they view as having facilitated fraud or consumer harm. And you can see here we just have some of the most recent enforcement actions listed. And we'd expect that to continue at the federal level as well as at the state level, based on the guidance that Gerry and Allyson and Andy were given earlier about how the states are going to continue to kind of beef up their consumer protection activities.
Now, Andrew, 11 states for recreational use have legalized marijuana. There's also, of course, medicinal use in far more states. No shortage, though, of legal issues because of the disconnect between federal and state law, including the fact that we actually included a disclaimer specific to that distinction. For those that are not engaged at all in that area and don't have the background, what's the basic distinction to be drawn in marijuana-related activity?
Yeah. So it is important to understand the key kind of definitions and terms here. So marijuana remains an illegal substance under the Federal Controlled Substances Act, and marijuana is from the cannabis plant, and that remains illegal under federal law. Now, notwithstanding the fact that marijuana remains illegal, hemp and products that are derived from hemp, such as CBD, were removed from the Controlled Substances Act under the Farm Bill in 2018. So it's really created kind of a dual track here where you have marijuana, which is defined as basically as having 0.3% or more THC as being illegal, hemp, which is 0.3% or less THC as not being illegal. And one of the challenges there is that CBD has become a really hot product, but CBD can be derived from either marijuana or hemp. So it can get very confusing. And on the marijuana side, what's interesting is that even though it's illegal, there are a number of banks and credit unions that have begun providing banking services and related services to the industry based on federal guidance that has been issued, which in very short form essentially says, if you do it very carefully from an AML perspective, that there's very low risk of enforcement against a financial institution. But at least on payments on the marijuana side, the card brands continue to take a pretty aggressive position of saying that if it's illegal, we don't want it touching our network at all. On the hemp CBD front, because it's no longer illegal, there are payment processors, there are banks that are looking for to provide services to the industries. But again, even though it's no longer a controlled substance, it's still an extremely complicated space because hemp and CBD really intersect with federal food and drug law, with unfair deceptive acts and practices, marketing type issues. So even if you're looking to provide services in that area, you have to do so really carefully. And so with that, I think Gerry was going to walk us through some other payments developments involving prepaid card developments, in particular with respect to the CFPB.
Well, not to keep bringing it back to the CFPB, but I will just briefly. In an interesting lawsuit, PayPal filed a challenge to the CFPB's prepaid card rule, which, as many know, it was a very onerous and comprehensive rule that covered both prepaid cards, bringing them within the scope of Regulation E and the Electronic Fund Transfer Act to the extent that they weren't covered, and also added a prong covering credit as it was related to prepaid. The rule was delayed a number of times, but then came into effect in April of last year. And briefly, some of the assertions by PayPal relate to the fact that the prime product that PayPal provides is a digital wallet, not a prepaid card. That's sort of an ancillary part of their services. And they nonetheless have to comply with this onerous rule that mandates, among other things, confusing disclosures and a cooling off period, so to speak, related to linking credit cards to certain types of or prepaid accounts. And so the basis is that under the Administrative Procedures Act, the CFPB didn't follow what it was supposed to, and so as such, the entirety of the prepaid card rule should be thrown out. And I don't want to belabor reading the slides to you all again because we do have a short amount of time left with a significant amount to cover, and so let's move on next to the regulatory agenda.
Well, Gerry, it's a good segue because the PayPal lawsuit illustrates the significance of regulatory rulemaking, particularly at the CFPB, but also the significance of vigilance by companies and industry with respect to the rules that may be promulgated in active participation in comments, et cetera, because the rules can have a real-world impact. And so A real question, of course, right now, though, is now multiple years into the CFPB's various regulatory initiatives, some may actually come to fruition. At the same time, current administration is rolling back others that already had. So, Andy?
So I'll be quick, but I was in the CFPB's rulemaking office, and my take on this is they have a very active rulemaking agenda. They have a slightly different set of priorities. They're not looking necessarily to go in and aggressively change the market the way that they were under Director Cordray, but they're still doing quite a lot. Some of the initiatives coming up for this year, the big one, probably the biggest thing that the CFPB is doing is retooling the qualified mortgages rule. There's been reliance on the Fannie Mae, Freddie Mac, what's called the GSE patch, since the rules were first passed in 2013. That sunsets, and they're coming up with a permanent replacement. They are in the advanced notice of proposed rulemaking stage right now, where they're taking feedback and figuring out what they want to propose, but that could be quite significant. They could change the mortgage landscape. They have several other initiatives. Jonathan mentioned rollbacks. The payday lending rule is really, getting a death by 1,000 cuts is the way to put it. They've constantly been rolling back parts of it, taking comment. I think they're doing that carefully so they don't get an APA challenge from consumer groups for essentially retracting a rule that they had already finished. That's ongoing. They have several changes to HMDA, which are really the Home Mortgage Disclosure Act, those rulemakings which are designed to accommodate small institutions and limit what's available publicly for, let's say the plaintiff's bar. They also have some other initiatives like small business reporting, which would be a reporting statute for fair lending purposes, very similar to how HMDA works in mortgage and so on. And they're also they're working on the debt collection rule. Jonathan, you're going to dive a little deeper into that one.
Yeah, the debt collection rule is one where it's been in the works for quite some time. If you go back to even 2014, some of the initial proposals, what's out there now is nothing like what was originally proposed, and that's probably the biggest takeaway. The second is that the Notice of Proposed Rulemaking did come out in May 2019, where we modernized communications in connection with debt collections, such as creating a safe harbor for voicemail messages, which is a big one, and the use of text and email. It would also enhance the prohibitions and interpretations around harassment, abuse, and false or misleading representations in collections, and importantly, clarify requirements for certain consumer-facing debt collection disclosures, including the validation notice and the creation of a model form, which would provide a safe harbor. All of those were subject to notice and comment. There's over 12,000 comments that the Bureau is currently working through, and they're also likely to publish a supplemental notice of proposed rulemaking related to time-barred disclosures this year and probably in the first quarter. All of that is to say is that they're close, but they're not yet finished with a final rule that has been eagerly anticipated now for several years. And realistically, there's timing considerations because of the presidential election, depending which direction that goes, as well as what direction Congress goes. There's Congressional Review Act potential of whatever comes out of this process. That being said, they're probably close to being in the fourth quarter, but not yet in the last 2 minutes.
And again, a shift to a more disclosure-oriented, business-friendly rulemaking.
Absolutely.
Yep.
Now, another two things to keep an eye on for 2020. The CFPB Task Force on Federal Consumer Financial Law was just announced last week, harmonizing, modernizing, and updating federal consumer financial law. That's essentially an outgrowth of what the CFPB was doing about a year ago with all those, or 2 years ago rather, with all the different notice and comment requests on different areas of consumer financial law. So you'll probably see a lot of thought pieces come out of that and eventually proposals, again, to shift the tenor of regulation. And potentially defining abusive. Director Craniger signaled that there may be some news on that this year. And that continues to be a hot topic, although in some quarters, unfair and deceptive has essentially arguably already included abusive claims, at least in practice, the way it's used. And lead generation continues to be a huge focus by FTC and CFPB. They've come out with some guidelines, and for those that would like to, we've got a whole presentation on this on our website at Venable.com. So Andrew mentioned this, and so did others today. On the state level, for those that are supervised, regulated, and licensed, you may already be familiar with this, but the Conference of State Bank Supervisors has put out a plan to modernize state regulation of all the independent verticals that are regulated by states and modernize the multi-state licensing system, the NMLS. Those changes potentially will be significant, both as a practical matter for those in compliance on a day-to-day basis, but also in terms of harmonizing, in some cases, disparate state laws, particularly in the areas of money transmission, consumer lending, and also even in some of the other areas that are on the NMLS system. Of course, not in each state, other than mortgage, not all areas are on the NMLS system. But for those that are looking for some streamlining, keep an eye on that. No promises that the NMLS system itself will be any easier, but it certainly will be undergoing some shifts. And of course, state trends. The reality is that there are the many CFPB proposals and plenty of coordinated exam activity for those that are out there. So, just very briefly, Andy, innovation and sandboxes. In a thumbnail, what do people need to know?
So the way I'd put this in one sentence is the CFPB has essentially gotten rid of Project Catalyst, and they have a real trial disclosure, no action letter policy, and a fintech sandbox. They are partnering with several states. Again, to the conversations we've been having, it's interesting that the list of states that they're partnering with tend to be red states like Alabama, Arizona, Georgia, Indiana, South Carolina, Tennessee, and Utah. But the CFPB does have a more robust no action policy. There have been some requests that have already been granted by the Bureau, and there's reason to believe that it has real teeth. There may be some challenges. There's some controversy in some of these other states like New York and California, but the CFPB does have an ability to issue safe harbors under the rules that it administers, and that is a fundamental difference between this program and what previously existed under Project Catalyst, which was essentially a soft promise for the CFPB not to sue you. So I think there's some potential there. We've gotten a lot of interest from clients about exploring it, talking about it, and it's there. I expect it to grow, and as long as there is an Office of Innovation, this will be something that the Bureau takes seriously.
Yeah, and the opportunity for this is now. It won't be later.
That's correct.
People should be looking at it now if they've got it, and synchronized with government affairs and how it coordinates with the idea of modernizing consumer financial law. Some of this is the precursor to that.
Exactly.
Josh, view from the Hill. I mean, there's no shortage of proposals out there.
I can be pretty quick about this, but I think people should look at the Hill right now. First of all, just kind of understanding that on the Senate side, other than what you're going to be hearing out of Elizabeth Warren on her campaign and maybe out some other candidates, there's really not a lot of action there. So I think you're really looking at Chairwoman Maxine Waters. So I would break up what I think she's going to do into four distinct buckets, and a number of them are kind of looking towards a change in administration. I think one thing that people have to remember is that absent a particular ruling in the Seela case, Kraninger is there until 2023. So I think you are going to see both Warren maybe working with Waters maybe working with Warren and on the heels of her letter to the IG, start to build a case for a possible removal of Kraninger if a Democrat comes in. I think having Kraninger there for 3 more years is going to be untenable to whoever is the next president, and I think you're going to need to see, the only way they're going to really be able to pull off a removal is if they can really show that she is being delinquent in some way in enforcement, and so I think you're going to start, you're certainly seeing that on the Warren side, and I would not be surprised to start seeing more oversight hearings of the CFPB to start to build that record. I think along the lines of also looking at her second or maybe first priority for this year is going to be fighting the CRA proposal that my colleague Laura talked about. She's sort of told people off the record that she's looking upwards to 10 or 11 hearings. They're in a back and forth right now with OCC Controller Otting about coming to testify at the end of the month. She showed up at the OCC hearing that where they released this rulemaking, and the FDIC hearing where they released this rulemaking. This is a huge existential issue for her. It has been for 30 years, and it is something that she is going to be really, really focused on. As far as moving towards more specific consumer protection legislation, I think this year I would look at for two bills that she's going to put through and put right to the floor. One is on rate cap, rent to bank, whatever you want to term it. We talked about that a little bit earlier, but that is actually a bipartisan proposal to set a national rate cap at 36% to prevent some of the issues that my colleague Laura and others were going over. I fully expect that to go through the Financial Services Committee and the House floor. Look for that to be introduced in the next week or two. Also on credit bureaus and consumer credit bureaus, that's probably her other big priority, and I would look for 4 or 5 bills to go to the floor, giving consumers new rights to challenge information within credit bureaus and new duties on credit bureaus to fight back. And I think lastly, a pushback against, I'll say big tech, not all tech, but big tech getting into banking, and that really is where you see the frontal challenge on the industrial loan company charter legislation, which I'm not sure will go through, but it is a broader issue that the Hill is going to be paying a lot of attention to as to whether, let's just say it, Facebook can get a bank. But it certainly has implications for companies much smaller than Facebook. So I think those are the 4 buckets that put this in. All or most of which is going to be looking towards next year to start to push things through if a Democrat takes the White House.
And Josh, obviously with this being a presidential election year now, what type of calendar are you looking at, and when should folks be paying attention to what's happening on the Hill? I understand they should be paying attention all the time.
All the time and every day. But
when are we expecting like sort of these intervals where, just like for instance in December, some stuff actually got through House and Senate? Yeah.
So I would look at the beginning of this year to look at the hearing and the markup schedule within the House Financial Services Committee and see what they're sending to the floor. And then throughout the year, you'll see votes on the floor on these things. And then I would look to the end of the year to see what gets into end-of-year spending deals and last-minute budget deals and things like that for things that might pass. I think most of the things I've outlined will have a tough time getting across the finish line because of the Senate. Even rate cap, which is bipartisan and bicameral. But I think these are things that will come right up roaring to the forefront if you have a Democratic president. And I would note that includes if Biden gets in, because I think even if you have a Biden presidency and his notion wouldn't be to necessarily try to go fire Kraninger or make a big fuss over the CFPB, especially given his Delaware roots, Warren and others are going to have a tremendous influence over consumer financial policy no matter who is president next year.
Well, so folks really should stay tuned. So, well, thank you for that discussion. We could have had an entire panel on each one of these topics, and in fact, in some cases, we actually already have, and have a ton of articles and a variety of other presentations on our firm website for those that are interested. So, briefly, some closing observations, and we will start with Andy. Any final thoughts for folks to be keeping an eye on, things that you particularly want people to focus on?
I would say continue to watch the landscape on True Lender and Valid When Made, and that there's, and also what happens on the state level, because there's consumer lending is a hot area. There's still just, it's all over the map in terms of what rate can be charged and so on. What sort of partnership is considered valid and isn't. That landscape constantly evolves, so I would keep a watch on that.
Laura?
In addition to the True Lender and Valid When Made, I would also watch for some kind of fintech obtaining a bank charter, probably more on the ILC side, but I think that it's not going to be some of the more controversial charters, but probably a smaller organization that probably doesn't have a commercial owner and that provides, even through technology, more basic banking products and services.
Allyson?
I am watching really closely what's going on out in California with the creation of a so-called mini CFPB, and I continue to watch very closely the Department of Financial Services in New York. Those are my big takeaways for 2020, in addition to, of course, the election.
Andrew?
One of the things we didn't talk about in the payments side that I think is going to continue to be an issue is this concept of convergence, where you're seeing payments companies getting into the lending industry, you're seeing lending companies getting into the payments industry, and kind of swirling all around that are the charter issues that Laura talked about, and then also, the concepts of open banking and how banks are kind of positioning themselves to compete with fintechs in that area.
Gerry?
A few areas that I think will be of interest, and one that we didn't really touch on today, which is blockchain technology and cryptocurrencies. It will be interesting to see how the CFPB, the FTC, the prudential banking regulators, Federal Reserve Board, just by way of example, look at that area, and as it grows, innovates, and emerges, how that will be regulated. It will also be interesting to see what happens overall with lending. If my data is correct, credit card debt is at a high level, as well is auto finance. I believe auto debt is at an extraordinary high rate, and the only real federal regulator over auto holistically is the Federal Trade Commission. So I think those are some areas to watch, as well as industry consolidation, to see if regulators take any steps in that direction as it relates to either financial services or payments.
Jack?
Watch the House and Maxine Waters to see what a Democratic administration would look like for consumer financial services.
And, overshadowing all of this, it's rare that anyone ever gets what they want simply by playing in the fourth quarter, and it would seem as though time is now ticking. That's really, I think, in kind of the undercurrent of a lot of what's happening, in part because in some cases, some of these proposals are in the fourth quarter. They're close to being finalized. Some things that actually were even started in the Cordray administration. But that being said, the march of time seems omnipresent, and when looking back over now the 9 years or so that we've been doing a variety of these outlooks, the reality is that a lot has changed. But even for those that feel like they've been in the middle of it all, the reality is that there's just been a dynamic environment, but there's one now that the pendulum has clearly swung in a particular direction. But it could swing back, and so I think timing is going to be everything. The biggest challenge for everyone, and especially those that are in-house and involved in legal and compliance work, I think continues to be the day-to-day work and the influences of RegTech and artificial intelligence and not necessarily absorbing changes in the law, but actually implementing them, safeguarding the organizations that they're a part of, and then managing that workload. And how humans and technology interact is, I think, going to be something that we're going to continue to see to be a theme that's going to be impacted by regulation, but also be something that folks on this webinar are going to be impacted by significantly. So with that, I'd like to thank everybody today, all of our panelists. And before we go, one more reminder, you can catch many of our articles and presentations as part of our CFS Digest and on our firm website at www.venable.com/CFS. We'd enjoy catching up with you, too. If you have any questions, please email them or call us. And also, I'd like to thank all of those that were involved in putting this together, as well as the team today and our presenters, Andy, Allyson, Andrew, Gerry, and Josh, and Laura. And with that, we will give the CFPB code in just a moment. Thank you very much.